Hello and welcome to this special CIO Flash update focused on the Covid-19 pandemic. As we near the end of March 2020, containment measures have moved from Asia to Europe and North America, shutting down economies. The shock is global, profound and durable. A global recession is in the cards for the first 6 months of 2020. And to understand the impact of the Covid-19 crisis, we have been closely monitoring three aspects: public health measures, monetary response and fiscal response, with governments and central banks taking decisive and substantial health, fiscal and monetary steps. We expect a significant but still transitory shock, followed by a recovery in the second half of the year. The essential question now is whether the shock can be contained in the first half of the year, limiting defaults and stopping unemployment spiraling out of control. Importantly, for this to materialize, we need to see that the public health measures are effective over the coming weeks. Let us now turn to Stéphane to assess the impact on our portfolio positioning and discuss the likely scenarios for the months ahead.
As Sami explained, the key question is whether the global economy faces a short-term shock or something worse. And the answer depends on the effectiveness of public health measures. In the meantime, financial markets have sold off and our portfolios have inevitably suffered. Since the beginning of the year, we have focused on carry strategies and kept a slightly underweight position in equities. This has been balanced with a number of portfolio hedges, including gold and put options. Over the past weeks and months, we have been steadily raising our portfolio's defenses. First, we added US Treasuries in January as they offered both yield and act as a cushion. Then, we bought Japanese yen mid-March against portfolios euro, US dollar and sterling-based currencies, as well as against the euro in Swiss franc accounts. The yen should benefit from the fall in US yields and provide a hedge if the pandemic worsens. Finally, we've just increased our allocation to gold as the precious metal should be supported by the Fed rates close to zero and massive quantitative easing by most central banks. We have also kept our original 2% underweight in equities after rebalancing to take account of the market drift after the declines so that portfolio can benefit from the eventual recovery. Longer term, there is more potential upside than downside risk thanks to low interest rates and low oil prices. Now, we cannot rule out a more negative scenario of a drawn-out pandemic if containment measures in Europe and North America prove less effective than in China and South Korea, or if the virus returns to Asia in a second wave. If this happens, economies will suffer extensive corporate default, unemployment will rise sharply, and another global debt crisis will loom. Such an adverse scenario would imply 15 to 20% downside on equities and further losses in high beta fixed income and emerging assets, while gold would rise. Finally, there's the risk of financial markets closing to stop sell-offs. Trading has been halted several times globally, with circuit breakers activating when indices drop below set thresholds. While China closed its exchanges during the Lunar New Year holiday, the Trump administration looks set to keep markets open. Markets have rarely closed throughout history, and for now, investors can accept no more than reduced trading hours. We are living through an exceptional period of market turmoil. Our portfolio positioning remains prudent. Compared with our strategic benchmark, we are 2% underweight in equities, 6% in fixed income, and we are 2% overweight in real estate, 6% in gold, and 3% in Japanese yen. We will remain agile and continue to adjust position as event unfolds. Thank you very much for watching and keep safe.